Welcome to my channel. I'm John Watkins, and today I'm going to give you my ultimate guide to using supply and demand zones. This will be a more in-depth and improved version from my original video. I'm going to go over what they are and how to use them from start to finish. We're going to talk about why you should always use them, whether you're trading futures, stocks, ETFs, crypto, or options on any of those. Anything that is an auction process, they will work on. So it won't work on things like the VIX, but will on ETFs like XLF or XLE. I'm also going to go over some psychology of trading and using zones to help reshape the way you might think the market moves. And this is probably, in my opinion, one of the most valuable parts of this lesson. Supply and demand zones help you trade with the dynamic of the market and provide risk-assessed trades with entry and exit points. Whether you are a bull or a bear, supply and demand zones give you the edge you need while keeping you from trading blind. Be sure to watch the whole video and stay to the end to see how to use and draw these zones. And make sure to subscribe to my channel, as I'll be rolling out more content soon, and you're not going to want to miss what I have next. Let's get into it. Alright, so this is the supply and demand trading. So quick disclosure, this is just for education purposes only. I'm not a licensed financial advisor. Please consult with a licensed financial advisor before making any investment decisions. So, supply and demand. The key points I'm going to go over are how the market moves, what are supply and demand zones, how to draw them, getting out of retail trading habits, how to use them in your trading to anticipate moves, and trading all-time highs if the equity you're trading is at all-time highs or the market ever gets back up there. So, institutions move the market. This is the main thing you have to keep in mind when you're learning this. Price only moves up based on buyers versus sellers. More buyers push price up and more sellers pushes price down, right? Very simple. I'll learn that in basic economics. Retail traders cannot influence price action like institutions can. Only institutions can trigger large enough orders to move price, right? So Joe Blow and whoever hitting the ask for 10 shares or 100 shares, that's not moving the market. Institutions that can really hit volume and really put large enough orders to move things, they can influence price a lot more than retail traders. All right, retail traders actually provide liquidity for institutions. Institutions do not care about your feelings. They will bankrupt you and they'll laugh about it over Nobu. Some people don't know what Nobu is. It's very expensive sushi. So we need to arm ourselves so that we don't get finessed and we don't get screwed over, for lack of a better word, by these institutions. All right, they want to make money and retail provides liquidity, and their whole goal is to basically get your money. And our job as traders is to find our edge and to not let that happen. They can take other people's money, but they're not going to take ours. So how they move the market. First, we must understand the auction process. There's balanced areas and imbalanced. Balanced areas, when market participants are agreeing on price, we have a balance between buyers and sellers, which creates liquidity. This is also known as consolidation or chop, right? When we're going sideways, we are balanced. Imbalanced areas, when market participants are not agreeing on price, either demand exceeds the supply or supply exceeds the demand, causing an imbalance and an illiquid area of price where order flow favors either the buyers or sellers more. If you have more supply, then there will be a steep drop in price, leaving unfilled sell orders up above. If you have more demand, there will be a steep rise in price, leaving unfilled buy orders underneath. So a supply zone, when price drops too fast, there are institutional sell orders waiting to get filled. Often when price moves back up into this zone, those unfilled orders get triggered, causing the price to fall again. So you have sellers, right? Stock comes down, it comes back up. There's sell orders, essentially. Think of it as unfilled sell orders waiting here, right? They leave the orders, basically they're working orders. It's not like us where you go to sell 10 shares, it doesn't get filled and you cancel it. There's unfilled orders up here. There's an area of supply. This is an area where sellers are going to step in. Comes back up into this supply zone, those orders start getting triggered, and then the price moves back down because the selling strength comes back. Basic supply. Demand zone is just the opposite. When price rises too fast, there are institutional buy orders waiting to get filled. Often when price moves back up into this zone, those unfilled orders get triggered, causing the price to rise again. So you have the stock move up, creates this demand zone, comes back down, hits the demand, buy orders come in, demand hits, goes up, hits the supply zone, sell orders start getting triggered, price falls back down into the demand gets hit, comes back up. And there's this sort of dance that goes on when you start to learn these zones where it's always going to be moving between supply and demand. And once it breaks through a supply zone, it'll create more demand and go back up, or it makes supply and comes back down. But it's always kind of moving between these areas of fair value, of being too oversold or too overbought. It's not like RSI though, because we're actually going off of price action, and RSI is like an oscillating lagging indicator. So a basing candle is what we're going to look for to draw in zones. Basically a candle of consolidation where there is no clear supply or demand. Typically the candle is a upper and lower wick where the open and close are close together. So this is sort of a textbook candle, and you don't need to worry about the color. For me, I've seen demand zones form, whether this is green or red. This is what it looks like. You have a body with wicks on the top, right? Price, they're agreeing on price. There's not really up or down. The next candle shoots up. All right, this is now a demand zone because price moved up so fast. A lot of trading was going on here, and the buy orders didn't get filled, and then we move up. Drawing demand. So you find the big move in price, and you use the candle before it to draw. So you can see the zone starts at the upper body right here. So on a red candle, this would be the open, and then on a green candle, it would be the close. And you use the upper body down to the lower wick. So basically, on a demand zone, the top wick we don't look at. You don't use that wick. That's non-information we don't need. And you go to the lower wick. This is your classic demand zone, what we're going to be looking for, what you're going to train your eye to see. Drawing supply is similar, but reversed. You find the big move in price down, and you use the candle before to draw it, using the lower body, the candle of the higher wick. So the inner wick, again, does not matter. We're going to go for the open if it's a green candle, or the close if it's a red, to the top wick. And now this is a textbook supply zone. Old supply does not become new demand, and old demand does not become new supply. This is not support and resistance lines. These are zones based on price action and where trading was occurred. This is basically going off of order flow in those areas, not support and resistance. Once the supply zone and demand zone is traded through, it's invalidated. I delete them off my charts, and I look for new fresh zones. They represent areas of unfilled orders and levels of potential support and resistance. Once the stock is traded within the zone or breaks through it, the zone is invalidated and you can simply delete it from your chart. If the zone is tagged a few times, it may still be valid, so you can alter the color or simply leave it on your chart until it is traded through the zone. Sometimes it'll retest the zone, so I'll keep them on my chart until it breaks through. Sometimes it'll tag the zone 3, 4, 5, 6, 7 times, and like a supply zone price comes up, and it just will not go above that supply zone. So I leave it on my chart until it's pretty much traded through, and I can tell that it's no longer an active supply zone or demand. So now we have to quit thinking like a retail trader. For every buyer, there is a seller, right? When you are selling a stock, you have to ask yourself who's buying it. Oftentimes, you're selling it at a loss into a demand zone where someone else is waiting to buy it for cheaper. Or when you're buying a stock, often you're buying into a supply zone where someone else is selling it to you at an inflated price, right? So you're buying the stock thinking it's going to go up, and then someone is selling it to you because they think it's going to go down. Or you're selling the stock because you think it's gone too high, but someone's buying it thinking it's going to keep going. All right, so you have to think about these things. Are you selling it based on for a specific reason, right? And so we look at zones. If I'm buying in a demand zone, I'm comfortable to hold it into a supply zone. Or if I see it going into a supply zone, I don't want to start buying because there's a good chance that sellers are going to step in because there's going to be a supply. So you have to start thinking about these when you're trading. Is the market really against you? So how many times have you said or seen someone saying some version of this? Every time I buy a stock, it tanks. Every time I sell a stock, it skyrockets. Oh, I just sold my stock, everyone, so I'm sure it's gonna moon tomorrow. I suck. I can't ever be on the right side of the trade. Oh God, why me? I can't believe Wall Street Bets was wrong. Well, I've been there. I think everyone's been there at some point if you're a trader. And it mostly comes down to your own psychology and not fully understanding the market or the chart. The reason the stock jumps after you sell it is because you're selling into an area where there is demand, and those pesky institutions are waiting to buy your orders for cheap to write it back up. Right? We talked about retail traders provide liquidity for institutions. A stock is selling off, it's hitting stop losses, you're scared, and you sell the stock in an area where it's going to start bouncing. All right, we talked about that, right? Retail traders provide liquidity for institutions. All right, they're moving a lot of shares, and they need retail traders to buy or sell their shares to. They need you guys, they need us to scoop up their shares when they're selling it because they need to get rid of them. So let's take an example and look at this chart. So what do we got, right? We have lower highs, downward pressure. It's underneath the moving averages. It's selling off pretty heavy. What do you do here, right? Do you stop out? You put a stop loss in. Do you buy it here? Do you miss the move? What is the move? What's going to happen next? I mean, the market's trading. Or what if you're in the trade and you're down a lot? What if you got in right here at the open and now you're seeing a lot of red? You got to follow a risk management plan, right? And you got to cut losses, right? I mean, what would you do? Think about it. If you're honest, you're probably going to say, I'd probably stop out, or you'd know that you're like holding and hoping because this is looking bad. I mean, imagine if you got in on this first green candle or this green candle and then it's just tanking now. This became this chart on the right. I'm down so much I have to cut my losses, but it was going into demand zone. There's actually two demand zones here. It sold right into a demand zone and then boom, started going back up and then ultimately ended up making new highs on the day, and it pretty much ascended the entire day. This was NASDAQ futures at the time. So you can see the perspective of if you're a new trader, right? You can, depending on where you're at watching this video, if you're a newer trader, this is something where you're just, most of us would puke and just get out off the bat. More experienced trader might hang on and see, but this demand zone gives you the conviction to either, if you're in the trade, you can at least give it a little more time. You know it's going to hit this demand zone. See if we can average in and maybe catch the bounce and get out. Or if you're not in the market, for example, I'd just be waiting. If I knew the demand zone was there, I'd be letting it sell off, and then once it hit this demand zone, boom, I'm getting in long and taking my risk assessed trade up. Or if you're short, you're taking profit at the demand zone. So this gives you a clear entry or exit point, whether you're short or long, whether you're waiting, whether you're in a trade. Instead of stopping out and taking a loss you don't need to take, you can follow these zones and then potentially get into a trade or save yourself from a losing trade. So this is just an example of what can happen, kind of seeing it with the before and the after. So you sell your shares at a discount into institutions who ride the wave back up. You gotta think about this. If your dream car's price cut in half, would you not try and buy it? Yet in the market, our shares drop in price and we sell it to someone who's literally gonna buy your dream car with the money you just gave them. Right? If someone said, "Hey, this brand new Lamborghini, 100,000, I'm doing a 50% sale because I'm a good person," you might be like, "Oh my God, I gotta buy this." But you buy Apple stock at 150, it goes down to 135, and you go, "Oh my God, I gotta sell it. I gotta sell out of Apple. It's down $15." It's like, yeah, for right now it is, all right. But in 6 months, is it gonna be? It could be more. It might be less. In 5 years, it'll be more. Right? So you have to think about this as these temporary moves, right? You buy a house, if you buy a house, if the next year the market goes down and the house loses, you're not going to sell the house because it's less than what you paid for it. You know it's an asset that you can hold. Equities are the same way. If you're buying quality stocks, quality companies, just a perspective for you guys to think about. Right? We're so conditioned to take losses in life. Pay attention to this part too. Because this kind of blew my mind when I was thinking about it. Like, we buy a car and we're instantly down, right? As soon as you drive a car off the lot, it's negative. You buy a $1,000 phone and you trade it in next year for a $300 credit, and then you buy a new $1,000 phone each year. You rinse and you repeat. You buy computers, you buy Xboxes, you buy any sort of technology. For the most part, everything, as soon as you buy it, you're not going to get the money you paid for it back, right? Very few things that we buy every day appreciate in value. TVs, couches, I mean everything. It's just you never make money on it, right? We're just conditioned. If you ever been in a trade, and think about this, you ever been in a trade, you've been down $50 or something, and you're like, I don't want to lose any more money. I'm just gonna take the $50 loss, and you take the loss, and then it goes back up, and you realize, gosh, like, I didn't even need to lose that $50. I just didn't want to see red. I didn't want to deal with it. That's just your psychology being okay with losing money. When it comes to financial markets, you don't need to take those L's, all right? You can be the house. You can be on the side of the manipulation and take advantage of it. We know the markets are manipulated. All we got to do is see how they're manipulating it and just be like those fish that sit on the shark, the sucker fish. You just got to let them be the sharks. We just got to get those few little scraps of food, and we're good to go. You have to start buying when you would be selling and selling when others are buying, right? Everyone's selling here, looking to buy in this specific instance. Here you would be selling into demand when you should be buying at a cheaper price, right? Having these zones gives you the conviction to hold and the confidence to enter. You're not trading blind. You can actually get in an area where there's a probabilistic chance it's going to go up if you're going long, or if you're selling, you don't know when to take profit, you're not sure how long it's going to go, you can just take your profit here. This is a good profit. It sold off a lot. Boom. You get out. You don't have to play the guessing game and worry if it's going to reverse on you. Right? Think of it like you want a Ferrari and then you try and sell it for half the price. Does that make sense? Right? If you bought a Ferrari for, let's say you go to Vegas, you win a Ferrari on the gambling tables, and it's worth $250,000, and the next day you go selling it for $150,000. That's just stupid. So you got to think, trade like an institution. They're sharks, and they're trading, and they're out there to make money. And you got to think the same way. You don't have to take losses if you don't have to, right? If you took a bad trade, you got to stop loss out. But we're trading already based off of zones, based off of defined entries and exits. We're giving ourselves the best setup to begin with, so we don't have to take these losses. And you have to start, you don't want to just look at what's happening in the present and think that that's it. Like right here, you don't have to look at this and say, it's selling off, I have to sell, I'm going to lose all my money. In this instance, you would have sold for, you would have won your Ferrari, and then you would have sold it for half the price. So that's just a little perspective psychology to start thinking about. If you haven't been pondering those things when you're trading, take a look at your trading, look at your decision making. Are you making these mistakes? Are you stopping out early? Are you cutting your winner short? Right? Are you getting in this demand zone here? Are you buying down here and then selling it right here when you can really be making all this? Start looking at your own trading and thinking about the decisions you're making, if they're effective. So zones present a defined risk trade. If you take a trade, you set your stop at the top of supply and at the bottom of demand. So for example, this is a demand zone here. Let's say you get in this trade long, right? And this is a zone. Remember, it's not like as soon as it passes underneath this line to the penny, you got to stop out. But if it breaks underneath this zone, you're going to be, this is your stop loss. Now this is a 200 moving average. So you get in long. It doesn't really go below the zone, right? It kind of trades in it. It shoots up. It hasn't really just flushed through the zone. If this were to just continue going down, you stop out. It's invalidated. But you get in. It's in this area. Boom, it shoots up. Now you hit this supply zone. Now you have two choices, or three. One, you can take your profit. Two, you can just hold it. Or three, you can trim profit and leave runners, which is what I would recommend. Right? But if we trade in supply and we hold in the supply zone without dropping, this is very bullish. It means we can go higher, and vice versa in the demand zone. No bounce in demand is bearish. So it goes into the supply zone here. And the buying pressure is so strong that the sell orders are just getting scooped up. The buyers are more present, and then it continues to go higher. All right, now in this situation, let's say it goes into the supply zone. Boom, you get short. All right, now your stop would be right here. And this is a 5-minute chart, so the fact that we've already had this candle, once we're in this area, I'm already considering stopping out, or I've stopped out, because it should hit this zone, come back down. It doesn't. It breaks through it, but ultimately, hard stop at the break of the supply zone, we get out. That's a defined risk trade. You're not shorting and then just to see what happens. You're shorting to take a probabilistic move that it's going to sell off at supply, and if it doesn't, you know when you're going to get out, so you can trim your losses and not have to deal with this. Whereas if you didn't have this zone and you got in short, you might be holding it up into this area and you're going to end up losing more money. That's one of the main reasons I use zones and swear by them, and they're my bread and butter, because it's like having visuals. I got a start and a finish line when I'm taking trades because of these zones. So let's look at how to trade all-time highs. Now the market's not at all-time highs now, but maybe you're trading oil or another ETF, so this will kind of like show you how to trade if you're at all-time highs. If there is no price above where you're at, you don't have supply zones. So when a stock is at all-time highs, and this was Tesla post-split when 669 was its high, you wait for a supply to form on the back test as seen here. So, for example, this hit all-time highs in pre-market, then it sold off, and then it came back up, and now the next day it opened in supply and dropped. So you're waiting for it to make a supply zone, come back up, and then now the supply zone is your entry. You can see right here it formed a 1 hour demand in pre-market and then flushed through it. So let's say you got long at the open, you know it hit this supply zone, sold off, and then the fact that it broke through this demand zone, you're getting out. If you're long, you're getting out right here. If you're short, you're going to hold it because it just broke through this demand zone. Selling and strong is probably going to continue lower, and it did. All right, the highlighted circle would be the best entry out of speculation. It would reject supply. So if you're getting short, you're going to get in right here, speculating that's going to reject supply, and you put your stop at the top of the zone. So 669 or 670, that's your hard stop if you were to go short. That's the best way to set yourself up for a trade that you're not going to lose too much on, and you don't have to. Again, you're not trading blind. You're not going to be in here like, oh my God, it's like the Wall Street bet days where it's gonna go up forever and ever. Everyone's jamming. Everyone's probably buying at the open. Institutions are selling. Boom. All these buyers got wrecked right here. If they didn't have the supply zone on there, they wouldn't know. They'd probably just think it went up yesterday, it's going to go up today. So that's thinking like a retail, but we're thinking like institutions. Final notes before we go into the examples. Supply and demand zones are areas of potential moves. They're not rules, and you must watch the overall market. On big down days, we can sink through demand quick, so make sure you use technicals in conjunction with the zones to make effective trades. And again, they're defined risk when you set your stops at the break of the zones. So on days where we're really bearish, once we break through like 2 demand zones, when we start selling, I'm done looking for longs. Same thing with the supply zone. We smash through supply, 2 zones, we're going up. I'm done looking for shorts. I've seen especially on really bad market days where we're down 2, 3, 4%. I mean, demand zones are like paper thin. They just get smashed. As soon as I see that happening, I'm not looking for longs anymore, and it helps me get a good read on the day that, okay, this is a bearish day. We're gonna probably continue to make lows. I'm gonna get in short at the next pullback. So let's pull up TD Ameritrade and go over. I'm gonna draw in some zones, show you how I draw them in, so that you can practice and see sort of how it's done and get used to it. All right, now let's look at how to draw in supply and demand zones. And let me go ahead and make my chart clean so there's no zones. So I have my rectangle tool, and to access this, all you're going to do is double click or right click at drawing rectangle. All right, so I have it up here. So this is the 1 hour chart of Apple. So we can already talk about, right, we have right here our basing candle and then the nice move up in price. So automatically I see a demand zone. So I'm going to get my rectangle, I'm going to draw it in, boom. And I have it set to default. To change the colors, you can come in here and you can type in 1 hour demand if you want to. And you can change the price points. So I can come over here, and the open of the candle was 144.18. So if I wanted to be precise, I could go change it. And the low was 143.65. So I can do that. Change the date. So if you wanted to extend it or shorten it, and then you can pick the color. So for example, it might look like this, right, when you draw it in. So to make it look less green, you're going to come in, you're going to click green, more, HSV, transparency, and I do it around 75, 80. I just click in this range, and then that'll give you that nice looking color that doesn't, it's not an eyesore. And then if you wanted to extend it, instead of redrawing the zone, bottom right point, you just come to the date, and you can come over here and you can type in June 10th, and it'll automatically extend it. Now you can see what happened. It created this demand zone, price moved right back down into this demand zone, went right back up. And this, I actually took Apple calls yesterday because it was opening up in a demand zone. So right off the bat, you can see the power of this move. If you didn't have this zone, you might not know. So, and it created another 1 hour demand. So I would just come in here, and you can just do this again. Boom. Oops. Now, supply zone, same sort of thing. Body of the candle to the top wick. And then we'd go in edit properties. I go pink, more, HSV, and then boom. Now, obviously, this traded through the zone, but you can see if we go like a 5-day, 5-minute, initially Apple opened this demand zone, went up, hit the supply zone, and sold off. But it was a bullish day, and it kept going, broke through the zone, and now you can see it created a new demand zone imbalance essentially, and it shot up, and then now it's coming back down. It's staying in this range. So at this point, I would take this 1 hour supply off my chart because it's pretty much traded through it already. And what I do is I go through and I'll start at the daily. You can get like big daily demands, so I might put one like right here. And if you're not sure, like this doesn't look like a basin candle, just draw it in, because as you get more comfortable with trading with zones and practicing with them, a lot of times I didn't think something was a zone. It didn't quite look like it would fit like up here, right? Like I didn't know if this was like a supply zone. I just draw it in anyway, just to have that information. And 'cause sometimes it reacts in the same way because you still have a drop in price. It's still kind of a basin candle. It's just not like a textbook perfect looking one, but I draw it in anyway. And then I'll come down to the 4 hour. And this can work on any time frame. So even on the 5 minute, I mean, you can draw in 5 minute supply and demand zones. And you can see like right here, right? There's a 5 minute supply zone. Boom, I mean, look at this, 5 minute supply, and it's been rejecting it. So, and this would be if you're like day trading, right? So if you're using a daily time frame, you're going to be more swing trading. You're not going to be looking for quick scalps off of a daily supply or a 4 hour. But when you're doing like a 10 minute, 15 minute, 30 minute, 5 minute, I don't really use the 1 minute, but just to show you, there was a 5 minute supply and it stayed below this zone, right? Hit it, came back down, went up, came back down, finally tagged it a third time, and now it's rejected this whole time. So if you would have got short on Apple in this range, you'd be fine. I mean, you'd be in pretty much, you wouldn't have been stopped out, and you'd be in a winning trade right now. So that just shows you if you can use them on any time aggregate. I'll use them on the 2 minute when I'm scalping futures, like really, really fast price action. All right, you have the 30 minute, and so I'll go down from like the 4 hour, 3 hour, 2 hour, 1 hour, and just see what I can find. You know, for example, I would have put a zone right here, Apple. This is a supply zone. What happened? Price came back down, hit the 50 moving average, back into this supply zone, and sold off. And this was in April, and this was the last time it was that high. And I'm gonna keep this on my chart, and I'm gonna extend it, and I'll just type in like I'll make it go to July. So now I have this supply zone. So if we ever get back up into this zone, this is gonna be an active supply zone. If you come here, look at Octa. So Octa, for example, you see this demand zone right here? That is a weekly demand, and it's so far back I have to go and actually make it 4-year aggregate. You can see right here, weekly demand back on March 25th, 2019, and it took 3 years, and it finally hit this, stalled out, and then now it's going back up. These zones are valid until they get hit. You can leave them on the chart pretty much forever. It came all the way down, hit this demand zone, kind of broke through it, then it held here, there's another one it didn't hit, and then went back up. So I mean, getting long in this area. Now this is a weekly demand, so that's what I talk about, how if you would have got long at the first test, I mean, you could have got out here. But if you're looking to trade it, investing in it, I mean, let's say you just bought shares, you'd have to wait for this is a daily, you have to wait for 10 days, and then now it's finally going back up. So when you're looking at weekly demands, daily demands, it's a longer period, right? When you're trading a 5 minute, 10 minute, 30 minute, you're looking for shorter trades, right? Intraday, like the Apple example, that 5 minute, I'm not gonna buy options that expire in a year because there's a 5 minute supply, right? But I might buy them for the week or next week and trade that little reaction. So, and this works on ETFs, futures, all right? So let's look at the SPY. It works on ETFs. Let's go ahead and look at like a new drawing set, clean, and we'll start at the daily. All right, I mean, this is going to be a daily supply. We would draw this in. Now it's time consuming, but I take like 10-15 minutes at the beginning of the day or the end of the day, and I just look for like major zones on stocks I'm trading. There's no fast way to do it, but it pays off, because when you're trading intraday and you just have a a zone already there that you can trade off of, it's rewarding. So we have some supply zones. Now I'll go down to the 4 hour, take a look. This is the SPY. So I mean, I would call this right here a 4, a demand zone. We have big move in price up, and now it's stalling out. So we could even call this a little 4 hour demand zone, and we can see right now this is actually testing it as we speak. So come down to the 1 minute and you can see what happened. It hit this supply down to the penny almost, and it had a reaction. It went up. So if you are waiting for the long, it hits this, you can take your trade out of speculation that's going to go up. Now we talked about putting stop losses at the bottom. This is relative, because if you're taking an intraday trade, you're not going to buy as a SPY right here, buy calls, and then put your stop. What is, I mean, this is what? This is like over 0.5%. I mean, you're not gonna put your stop down that low. But for example, like on the Apple call, this is a prime example. If you got short at supply, once it pretty much broke 149.87 at the top of this supply, you put your stop. But if you're trading a large zone like the SPY here, where the zone is like a lot of price action, you don't have to wait for the trade to sink all the way here. You want to adjust your stop accordingly on a larger zone like this. So it's all relative. It takes practice. That's why I don't just take what I said as like gospel. I mean, practice with it. This is a lot of movement. Don't buy and then sell at the bottom here. Like, you should already be out if it's going to sink this lower. You can see right here, here's a 1 hour demand inside of a 4 hour. So I just draw in my zone like so. So now I have another 1 hour right here. So if this sinks to this demand, I'd be looking to get long about 408.69 on the SPY. And that's all you're going to do. You're going to come into different stocks, whatever you're trading. Tesla, right? Got a squeeze, TTM squeeze. Here's Tesla. I got a bunch of fibs and a bunch of levels, a bunch of demand zones. You can see right here, this demand zone marked a low. It bounced in it. That looks like that comes all the way. It's probably a 4 hour. That comes all the way from July of 2021. So yeah, that's probably a 4 hour zone that I had, or maybe even a weekly. Let's see. No, that's definitely a 4 hour zone. I know because I don't see anything. But if we go look, and let's make my time frame a year. If we go look, it's this zone right here. Boom, see? Nice little 4 hour. Now I put this one down to the bottom of the wick here, but you would technically go to the bottom of the red candle wick. But created this demand zone July last year, bounced in it here, bounced in it here, and I kept the zone on my chart, and we come all the way almost a year later, 11 months later, comes down into this zone right again. What does it do? It bounces. So even though it sunk to this demand, it bounced in this one. So this one is inactive. I'll just take that off my chart. And it created a nice new 4 hour demand. So I can go ahead and just delete this because that's old, and then draw this new one in because it's the same area anyway. Now I have this fresh 4 hour demand, but you can see how it was there for an entire year, and it came down and it bounced right at that demand zone with everything else. So that's why we want to put these on our charts and sort of keep active. Here's another one I can kind of see. We had a nice move down in price, and you get quick at it. Boom. Went above a little bit, and then it started selling off. So there's zones, right? It's a zone. It might go above it a little bit. It's not like support and resistance in price levels, but it goes above and then it sells off again. It comes back down into this area. So I would draw this as a demand zone. So these are the areas I'm looking for. I'm just want to give myself as much information as I can to make effective trades. And just for more examples, you can come to ETFs like XLF, and you can see right here, demand zone. Price came back down, hit it, went back up, created more demand zones right here. So you're just looking for these zones. It had a supply zone right here, right? Came back down, hit this supply zone, sold back off. So when you're in these trades, it gives you targets and areas to watch. Looking at NQ on the 1 minute, you can see how, traded up into this, came back down, sold off, stayed above below the supply zone, and this is a supply zone that was created on Monday, right? We had a drop in price, created a nice supply zone, came back up, didn't quite tag it, opened today into the zone, sold off. So, we had a really bullish day yesterday. Now you're opening up today and you're thinking, oh, we're going to have another bullish day today. Yeah, but we're opening right beneath the supply zone. We buy into it, and then what happens? We start selling off, going sideways, and we just can't break through this level, and eventually we just sink down through it. So off the bat, if you're trading tech, if you're trading Apple, you're trading the triple Q, trading Tesla, yeah, we have strong momentum in the market, but we're in this big supply zone on the main future, and we just can't get above this level, right? The fact that we failed to make highs quite a few times, by the time you get to this point over here, we're really not looking for the long anymore, right? Because it hasn't shown that it's going to go higher. If it breaks this high, we can look for that long and look for it to break through the supply zone. But what happens? It drops down again. And it drops down again. So when we're down in here, at this point, we should be looking for the short. It hasn't broken through the supply zone. It doesn't have the buying pressure. We're looking for the short now. So this supply zone helps you achieve your bias on the day if you're trading in the whole market. So that's why I always have zones. They're my bread and butter. I swear by them. Practice on your own. Draw them in. See how they work for you. Practice on sim first, or use small trades or small option amounts so you can get comfortable with them. Try it out and let me know. But that's how you draw the zones. So that's my lesson on supply and demand trading. I hope you learned some new tactics. Go practice drawing zones and watching reactions to get comfortable with using them. Make sure to practice your strategy on paper first and keep a tight plan of action and risk management outlined. If you want to learn more and have access to our community of traders, you can join our education service, the Phoenix Room, where we post our trades and conduct live trainings for trading futures, stocks, and options. And we do have a free area that you can check out. Link will be in the description below, and I will see you in the next video.